Welcome, everyone, to the PMA Bulletin, August 2022, a market review of where we are in this real estate scene here in the GTA. I'll try to bring you a picture of where we are and where we're going. Everyone's talking about it. It's the story of the month, of the week, of the day, as we review our lives in real estate and this quite interesting correction that we're now experiencing. You've heard all the numbers, and there's a lot of media coverage. I'll try not to be too number specific, but more broadly general commentary about this market and where it's come from, where it's going, and where do we think it's going to balance out, let me call it that, in the coming months as we go forward. Let me begin with the sort of resale pricing, and you've seen this correction from the peak in February of nearly 20%. Now it's at 19.4%. Really, our sense of this is that this resale community, the 95% of our housing stock, new housing's the tail on the dog, and we don't wag it without the dog barking first. So the resale market does its thing, and we adjust to it in new housing. And the scene that we've been faced with really is what we called, of course, quite irrational, frothy market in the first quarter, but it went before that. It probably began sometime in July or August of 2021. The period from July of 2021 until now, in a one-year period, actually shows the average price of resale. There's 95% of housing stock, as I've mentioned, almost now in balance, 1.2% change year over year. But when we look back at the peak of this market, which has now turned out to be around February of this first quarter of 2022, from the period from July to February, we saw an escalation in value of nearly 26% and a deterioration since February till now of about 19%. It's our sense that this market will adjust back to that July level of 2021. Why? Because the period prior to that, in the first year of the pandemic, and prior to that, in 2019, the movement of price on a monthly basis and an annual basis was fairly stable. It wasn't as irrational as it became in 2021. So we think that we've moved off almost 20% at the moment, and we will correct back to that summer of last year, somewhere in 2021, at around to 25%, or perhaps a little more, because we tend to overcorrect in these times with this market. So if you look at these values, we'd reached $1.3 million on an average MLS price in February. It's currently at $1.074 million. That's quite a significant change. But the pace of change is slowing. This is really important. We saw an abrupt reaction in the market in the early parts of March, April, May, and part of June, and a much slower pace to June and July. And so what that means, I think, is that we've seen a shock to the system. We've seen the consumer react dramatically in a very short period of time, faster than perhaps I have seen in many corrections in my career. But the certain direction that we're heading now is a much more controlled correction in response to rising interest rates. And I suspect that we've really only got a couple more months of this ahead. In other words, to take us back to that period of July of 2021 would require another 5 or 6% correction, 2.5 or 3% a month through August and September. So that by October we've stabilized, that this market has met its balance between these rising rates and the demand crushing, really, that those rates have exhibited. We have witnessed a market movement by the Bank of Canada now to 2.5%. This movement has affected interest rates that have moved from 5-year money from 3 to almost 5%. Add in the stress test of OSFI, and we are sitting at a qualifying rate of nearly 7%. Well, this has put severe damper on demand. The consumer took a pause, the development industry took a pause, and we both in turn sort of said, what's happening? Where are we going? Let's just sit back and take a look at this. This has resulted, of course, in sales you've seen in resale and new that are both off by 50% from a year ago and over 60% from the peak in February. And so this is a normal reaction to this rise in rates. It's a generational rise, as we've talked about before. We've never seen interest rates above 6% for 20 years. And so you've got a market of buyers or consumers out there who have never experienced this rapidity of change. And it's the rapidity of change that's key, not the level of change. We've adjusted. Through the 90s, we were an average 11.75% mortgage rate. So the market will adjust to this new rate in the 5% range, but it's the rapidity of change that causes inaction and confusion and therefore pullback on the demand side. So you've seen that on the price movement. We've got a couple more months to go before it stabilizes. On the supply side and the resale side, well, that just zoomed, of course, from just around 4,000 units in January to 15,000 units in July. Came off a little bit from June. It almost hit 16, but that's normal. That's a summer period. We take the house off the market in the summer, particularly when my expectations are far higher than what the market is telling me they're prepared to pay. So we saw a little adjustment in July. This will continue rather unabated for the next several months. I expect August numbers will come in around the same, but September and October will move it to 18,000 and then 20,000 units by October. So you've got an underlying push on the supply side, which is charging heartily to a market imbalance. You've got a softening on the price correction and a supply side moving to what we hope by October is a market in reasonable balance. So that's the story of the resale market. It's a picture that was quite predictable. I'm not sure that we had thought we'd see such a rapid change, but the Bank of Canada's response has been aggressive. What happens September the 6th? General market is talking, and the media is talking, which is sort of let's call it the consensus mood of another 75 basis points, which would put us at 3.25. Earlier in the year, the Bank of Canada's target at 3.25 wasn't expected until and projected until well into 2023. And here we are in September of 22, and we're thinking it may move to that 3.25 range. I sense with the job losses we've seen in June and July and the impact that's been so dramatic on the housing side that perhaps the Bank of Canada may be a little softer this time. And in fact, they actually don't need to be as aggressive as they have been. Although article in the National Post just yesterday, August the 16th, was by the governor, was reinforcing their target to 2% inflation. Inflation for the first time showed a decline from over 8.1% to down to 7.6%. So it's on the right track. Rate rises are doing their job. But he wants to be aggressive. They were late to the table, and they admit that. So we suspect it's probably a 50, maybe I'm being hopeful here, but around a 50 basis point rise in September, given the immediacy of the psychological changes that's happened in real estate, which is about 6% of GDP, so it's an important component part. And right now in the marketplace, we're seeing significant deterioration in employment in real estate. In construction is still strong because of the backlog, but in the service side of the industry, quite dramatic change going on. I think that this will be the measure of what happens through the fall. So let's expect at least another 50 basis points to around 3%, with the bank targeting at least 3.25, probably ending up at 3.4 or 3.5 in 2023. So I've got another 1% movement in interest rates. I'll talk about that a little bit later. Let's just talk for a second about the world of new housing. New housing is following the same pattern. Sales are off by 50%. Prices have not moved the same way, and they won't. Remember the fixed costs of hard costs of construction, labor and materials, the underlying push on cost, which has been significant. The settlements that have been made recently are big gains from the unions on labor at 20 to 22% in the first year and 4% thereafter, next couple of years. You're seeing materials start to come off a little bit as condo projects estimated by Urbanation at nearly 10,000 units that were to come on this fall have been put on the shelf. Projects are closing. They're not continuing. When you don't sell anything, you go, let's take a pause, see where I can move with this, and I close. So the supply is actually constricting, which is not a great sign, but for the future price point movement. But at the same time, product coming off the market means that we've seen the new housing market takes a much longer period of time to adjust. It ratchets down very, very slowly. This is what's already happened. Benchmark price from RealNet showed about a 6.8% movement from peak in February till now. Well behind what's happening in the resale market, but exactly what should be expected to happen over the coming months. We think that into the fall, you're going to begin to see some of the adjustments take place. This will come in a variety of ways. Major incentives from new house builders to try to move product and or inventory. We're going to see incentives in the form of upgrades, cash credit on closing. You'll see more canceled projects, more removed from the market. You'll see some of the issues of builders trying to get a consumer to contribute somewhat more to their base bottom line price of their product in order to move forward with a project. It's a real dilemma. When the hard costs have risen 30 to 40% in the last year, those fixed hard costs in some projects, the builder is caught and in fact is underwater. So that's where you're seeing this dilemma in the market of how to deal with that. I think fairness and disclosure, full disclosure, is really the key factor, working with the consumer and a builder to correct the situation where it can be. And where it can't be, you'll see projects just pulled right off the market and deposits returned. These are part of the symptoms of a market in correction, and it's very, very normal. So not to be alarmist at all, so it's very normal. I mean, frankly, in the month of July, nearly 5,000 resale units were sold, so people had some reasonable confidence there, and in the new house market, about 1,700 units. So these are off by 60-70% from the norm of a 10-year average, but people were still making that commitment and will continue to do so. On the new house market, looking for bargains. On the resale market, looking for the value that is there in this correction. So that's the good news going forward in the next couple of months. I think that what we need is a signal. We need a signal to the consumer who's been shocked that this is a good time to buy. Well, is it? Certainly with the correction going on, certainly within the resale market, it would appear to be. The next 2 months will be softer correction, softer movement, and balancing out by October. So your best deals are just in front of you as a consumer. But what I expect will happen, of course, is a bit of a shock on September the 6th from the Bank of Canada and the Federal Reserve in the U.S. with a movement upward again of interest rates. I expect, I hope, that it's going to be a little less aggressive than they have been. What it does mean, though, is that the fundamentals have remained unchanged. Supply side is negligible and getting tighter, not bigger. In fact, with product pulled off the market or product not being released to the market, both new and more product coming on in resale strong, but it will find that this supply side is being rather constricted even further. So immigration, though, continues unabated. With a target of 400,000, we've reached 270,000 by June, and we expect that this target will be met fully this year, and a target of nearly 1.3 million over the next 3 years. So you've got a demand push against a constricting supply situation. Why have rental rates soared? Well, there's your reason. The affordability crunch as rates rose has pushed people more into rental housing, and that shortages in rental have been obvious for a long, long time, and as a result, those prices have begun to move more dramatically on rental rates. That's going to continue for some time because we cannot catch up with the supply fast enough. Credos to the Ford government with a major mandate to help increase supply, but it's like trying to turn the tanker around in the harbor. It takes time, and it's not an instant add water and stir. So good intentions and good direction, but it's going to take a little time. So here we have what's the signal. Where is the signal to buy? Two areas that need to be considered by our federal government. It's interesting that it's the federal government that needs to be the driver of this. One is on OSFI and the stress test. This is redundant. This is piling on. We don't need the stress test review for qualifying a consumer as rates were rising. It was a brilliant move in 2017 and to protect people today, protected the consumer right now from these escalating rates. But going forward, we're in a period where these rates are going to stabilize. In fact, Benjamin Tall suggests that Bank of Canada rate in 2024 may be back to close to the 2% range again. So we don't need the OSFI qualifying rate. Let's suspend it for new housing, or suspend it for all housing, but particularly new housing. We need these jobs. We need this investment in the community. So there's a move that could be made immediately to assist in the affordability and for the consumer in new housing. The second is HST. Goodness, I know the industry's been preaching on this for a long time, but HST was brought in 1989 as GST with a rebate to the industry, recognizing that land had never been taxed. So there was a manufacturer sales tax at the time of 13.5% that effectively got shifted over to a 6% GST, and recognizing that land had never been taxed, the industry got a rebate level up to the first $450,000 of value in 1989, 33 years ago. It hasn't changed since. So here we are sitting with the same value attributed to the proportion of land from 1989, and of course, where has it gone in that period? My goodness. So HST needs to be reviewed on the housing side, and frankly, look at the value of land as the land component and remove the HST from the value of land, from the raw material of the building industry. This would be an enormous boost, a tremendous benefit to help in the industry adjust to the price reductions that they're facing right now, because they're up against a wall of increasing hard costs, soft costs, development charges, all moving in the opposite direction of the market. And so you're at a real catch-22, a real dilemma. HST needs to be reviewed, reduced, or eliminated for the land portion on new housing. Finally, supply is really the answer over the long term, and congratulations to the Ford government in recognizing this, and for the first time we're seeing some action taken. It'll just take a while. So I'm very hopeful that we're going to see by the fall a kind of much more balanced market. And in fact, this is going to turn out to be a very abrupt and contracted correction, and that by the fall, a much more balanced and beginning as we head into late fall and the spring of 2023, much more balanced market. We'll see you again at the end of end of Q3, and we'll have another PMA bulletin for you in October. Until then, have a great selling period. Good luck with adjusting to this marketplace, both for the consumer and for the industry. We need to work together to make this as great a city as it has been, to continue that presence on a worldwide scale. This is a great place, Toronto, and the GTA. It'll continue to be so. We're just going to go through a little bumpy period right now till we reach balance by later this year. Thank you. We'll see you again in October.